What are buffered exchange traded funds and how might they benefit you inside of your investment portfolio? These are the questions we're going to be answering today. My name is Spencer Ford, Certified Financial Planner with Conservative Financial Solutions, and just want to say thank you for watching this video. A buffered exchange traded fund is a type of exchange traded fund or ETF that allows investors to track an index like the S&P 500 while providing investors with a buffer against market losses in exchange for a cap on how much investors can profit on market gains. If you haven't watched our video on what an exchange traded fund is or an ETF, I would encourage you to go back and watch that video after this video just to give you some context. You can find that in the link in the description below. We're going to go over a couple of examples of how a buffered exchange traded fund works. As I mentioned, one of the indexes you can track with a buffered exchange traded fund is the S&P 500, which is made up of 500 large cap companies, with the majority of them being United States companies. You can also track indexes like the NASDAQ, which is more technologically heavy, the Russell 2000, which is a small cap index, or even some international indexes to give you some exposure there. Here's how it works. Suppose you want to invest in the S&P 500, but you don't want to take on 100% of the market risk of investing in the S&P 500. You might decide to invest in a buffered exchange traded fund. And based on rates as of this recording, you can invest in a buffered exchange traded fund that has downside protection of around 15% with a cap of 11%. Now, new offerings for buffered exchange traded funds come out monthly, so you'll definitely want to do your research and check on current rates before deciding to get into a buffered exchange traded funds. The outcomes for such portfolios as a downside protection of 15% and a cap of 11% are calculated annually. So I'm going to go over an example of what that looks like here. So suppose that you did decide you wanted to invest in a buffered exchange traded fund, and we'll just use the S&P 500 as an example because most people are familiar with what the S&P 500 is. And we're going to suppose that we're just starting at 0 in our example. So let's say over the course of the year, you're in this buffered exchange traded fund and the market goes down 15%. Well, like I said, you have a buffer of 15%. So if the market was down 15% over that time frame, you would be down nothing in terms of market performance. But let's say the market was down 20%. Well, you've gone through your buffer of 15%, so you would be down 5% due to market performance. Now, let's say the market went up over that year. So you're capped at 11%. So if the market was up 7% over the course of the year, you would capture 7% of the upside of the market. But if the market was up 14% above your cap of 11%, you would just get 11% in terms of market performance. Now, there's all different types of buffered exchange traded funds, and they come in all different shapes and sizes. So you could actually invest in an S&P 500 buffered exchange traded fund based on today's rates that has a buffer of 9%, but the cap is 16%. So it just depends on how much risk you want to take on. Buffered exchange traded funds, like I said, come in all different shapes and sizes, so it's going to be important that you do your research before investing. But is a buffered exchange traded fund the right investment vehicle for you? It depends on what you're looking for and what your investment objective is. Here, we currently like using buffered exchange traded funds as a bond alternative because bonds have a tough road going forward. You've probably heard me harp on that quite a bit if you've watched any of our other videos. The reason for that is because bonds are inversely related to interest rates. So as interest rates go up, which they're expected to do over the next several years, bond prices are going to fall. So here's an example I love to give. Suppose I have a bond that's paying a coupon rate or interest of 1%. And in 6 months from now, you can go out and you can buy a bond that's paying 2%. Well, you're not coming to me to buy my bond. So therefore, the demand for my bond goes down And if I need to get rid of it or want to get rid of it, then I have to discount it and potentially sell it at a loss. So we like using buffered exchange traded funds to replace a portion of the bond allocation inside the portfolio because it makes the outlook look much better. We also like using buffered exchange traded funds for money that's sitting idly at the bank in a savings account, checking account, money market, or in a CD, because it gives you a greater upside protection without taking on a ton of downside risk. Now, you might decide, I don't want to risk any of my bank money, and that's okay. There's plenty of vehicles out there that provide you downside protection where you don't have to worry about any losses and still better interest than what the bank is providing. But the other reason why we like buffered exchange traded funds so much is because they're liquid, which means you can go in a buffered exchange traded fund on Monday and get out on Tuesday, and there's no penalty. Now, if you get out intra-year or in the middle of the year in terms of the cycle for the buffered exchange traded fund, what that means is if the market was up over that time frame, you'll get a little bit of that interest. And if the market was down over that time frame, it's not going to be down as much as the market was. So if you enjoyed this video and found it helpful, please give us a like and subscribe for more content. It really does a lot to help out our channel. And the question of the day is, what do you think about the concept of a buffered exchange traded fund? Thank you very much.